Hello everyone, today, I'm going to talk about the best way to enter trades. It has the highest win rate I know of. It's somewhat similar to the videos I posted initially on my channel. And every time I take risky trades and incur losses, I always have to revert to the entry method explained in this video. By the way, since I started incorporating order blocks into market structure, I haven't made a single complete video on how to enter trades properly. So, let's get started. In any trading method, there are two types of trade entries: risky entries without waiting for confirmation, and safe entries that wait for confirmation. What trading style do you use? What do you base your entries on? Ultimately, it all boils down to those two types. So, what does it mean to enter a trade without confirmation, and what does it mean to enter safely with confirmation? Here's a downtrend. This is a key level with an unused order block. A critical key level. The price moves down here, it's insignificant, it's nothing, so we predict the price will continue to fall. With that prediction, when the price retraces to this level, to the unused order block at this critical key level, we enter the trade immediately. So, this is the risky entry without waiting for confirmation. You can also see that many trades I've entered this way. But still, this is a risky trade. Its safety and win rate are not high. So, how do we turn that risky trade into a safe one? In a similar scenario, instead of predicting as we did, we predict a reversal here. So, we enter the trade right here, at this exact moment, immediately. But let's hold off and wait for confirmation by waiting for the price to react correctly at that point, the exact point where we predict the reversal. Then the price bounces back. At this moment, switch to a lower time frame, and we wait for the price to reverse into an uptrend. This retracement trend, this is the confirmation. And this is the moment when we can start entering the trade. This is the safe trade. However, sometimes, we wait until we get confirmation. But sometimes, the market doesn't give us an opportunity to enter the trade. It just moves straight ahead, in one go. This makes us regret wishing we had entered the trade earlier. And gradually, encountering more similar scenarios like this, we get drawn deeper into liking early entries and accepting the risk to avoid missing out. As a normal person, this psychology is inevitable, and because of FOMO, we tend to enter trades earlier. But when our experience is insufficient, we pay the price with more stop losses being triggered. So, how great is entering late with confirmation? Let's dive into the chart. Here's the familiar pound sterling to US dollar pair I often trade. The current trend is an uptrend. And this is the key level of that uptrend. So, after the price retraces and retests this key level, it continues to rise. It moves up to this previous high, this strong selling zone. At this moment, we should look to find a selling opportunity. It might sound counter-trend, because the current trend is bullish. The trend is bullish. Trend is your friend. The trend is your friend, so we should look for a buying opportunity, right? Why are we looking for a selling opportunity? It sounds a bit contradictory, but it's not contradictory at all. Let's analyze it. In an uptrend, we only look for buying opportunities when the price retraces to a strong buying zone. In this case, it's the key level. At this moment, we look to find a buying opportunity. Remember, we're only expecting, not buying yet. We buy when this retracement trend, this pullback, reverses into an uptrend. At that moment, our expectation becomes reality. Then we look for a buying opportunity. So, after the price moves up, continues to rise, reaches this zone, this previous high, this strong selling zone, how can we buy anymore? Even though the trend is still bullish, it has hit this strong selling zone. We can't buy here. We can only buy if the price continues to rise further, continues to climb, and retraces back to the key level. Then we continue to expect to find another buying opportunity. But at this current moment, the price has reached this strong selling zone, the previous high. This strong selling zone, we should look to find a selling opportunity. The next step for us now is to analyze the current smaller uptrend. We analyze this current smaller uptrend, and we look for its reversal point here. And we wait to see if the price breaks through this reversal point, then we look for a selling opportunity afterward. Now, let's switch to a lower time frame. This is the smaller uptrend. The market moves like this. It moves like that, so this is the key level of that uptrend. At the same time, this price zone is an unused order block, perfectly aligned. It coincides with the key level, which is excellent. So, as long as the price breaks through here, we can confirm that this trend has turned into a downtrend. It reverses into a downtrend. Our task now is to simply wait. Wait to see if the price breaks through this price zone, then we can confirm that now the price is falling, and we look for a selling opportunity. If the price doesn't break through, we just wait. Wait for the price to continue rising, then we look for a buying opportunity later. The price stays in this price zone for a while, and finally, it breaks downward. It breaks through this price zone. The fact that the price breaks through this yellow zone is the confirmation that this previous high, this strong selling zone, has reversed the trend. So, at this moment, we start looking for a selling opportunity. Before, it was just an expectation, but now, this is the moment we look for a selling opportunity. Our task now is simple. We follow this smaller wave, this current downtrend. Let's examine this current downtrend. In this downtrend, this is the key level of this downtrend, and this is its previous low. Suppose this downtrend continues to fall, then two scenarios could happen. One, if the price retraces, at most, it will retrace to the key level, and then continue to fall. It moves like a textbook, retracing beautifully. The second scenario, the price follows the higher time frame. Following Dow theory, the price will retrace up, break through the key level, and move here to where this downtrend began, and then continue to fall. Those are the two possible scenarios. I usually prefer the price to follow this smaller downtrend, retracing at most to the key level, and then falling. However, of course, I won't enter a trade recklessly like this. I'll look for an unused order block near the key level. If there is one, I'll enter the trade. If there isn't, I won't enter. Near the previous low and near the key level, there isn't any unused order block. But above the key level, there's a small unused order block. And as per the video on entering trades based on stop hunts I made on my channel, we can completely predict that the price will stop hunt the key level, retracing here, and we can enter a trade like this. Pull down like this. But honestly, at that moment, I didn't spot it. Now that it's happened, I can see it, but at that moment, I didn't spot it. I didn't see it, so I didn't enter the trade like that. The reason I didn't see it is simply because the order block above the key level wasn't clear. It wasn't clear. It was very hard to spot, not clear at all. I didn't see it because it wasn't clear. And the second factor is that I rarely enter trades based on stop hunts. I leave it there, but I rarely enter trades like that. I don't overuse entering trades when we don't frequently enter trades. With a certain entry style, we won't spot it. I don't enter trades like this often, so I didn't spot it. It's that simple. So, at that time, I predicted the price would follow the higher time frame scenario, thinking the price would go straight up, back to where this trend began, before falling. So, I didn't enter the trade here, I waited. Until the price reacted strongly like this. Moving like this, strongly like this. Then I realized, this is the unused order block. Above the key level. Should I correct my mistake by entering the trade now, like this? Enter the trade after confirmation with a pattern like this? I decided not to enter the trade like that. If I didn't enter the trade like this, here, I won't enter here either. I let it go completely. The reason I didn't enter like that is not because I thought the stop loss was too wide. It's not that I disliked it. This stop loss is still quite short. The reason I didn't enter like that is simply because it's not safe. It's not safe because the current trend, the retracement, is a smaller uptrend. And here, this is the perfectly aligned unused order block at the key level. And this is a dangerous price zone, a zone where a reversal is likely. So, if I had spotted it earlier, if I were better and entered like this, when it reaches this dangerous price zone, this trade would have reached a 1 to 3 risk to reward ratio. Then I could manage the trade. At this point, I could have managed the trade by taking partial profits. So, if this trade doesn't go according to my prediction, I'd still have secured some profit from this trade. But if I didn't enter like this, and entered here, when the price reaches this dangerous price zone, this trade would only have a small profit, about 0.5. That's not enough to manage the trade. So, this trade is either a win or a loss, making it riskier. So, I won't enter the trade. If it's not safe, I don't enter. At this point, I wait again. I wait to see if the price breaks through this yellow zone, through this perfectly aligned unused order block. Then I'll enter the trade afterward. So, I enter the trade later. Finally, the price breaks through the perfectly aligned unused order block. At this moment, we can confirm that the price has stop hunted the key level and reached the unused order block above the key level. Remember, at this moment, we can confirm it. Before this, we couldn't confirm, and this is the moment we enter the trade. This is a great opportunity. Very good. Where to enter, we don't know yet, but the safe stop loss is definitely above here. This is a safe stop loss. Clear out the old stuff. At this point, I see a small order block here. It's not very clear, so I simply enter the trade here. And because it's not clear, my stop loss has to be placed above here. Remember, when we're not certain about something, place the stop loss at the safest point. If I were certain, I'd place the stop loss here, and it would be safe. But because I'm not certain, I place my stop loss here. It's safer and better. After entering the trade and setting the stop loss, the safest take profit is set here, where the uptrend began, achieving a 1 to 4 ratio. And if you trade, I recommend taking profit like this. Take profit here, don't aim too far. The next question is, can we take profit further out? Take profit to the higher time frame, to achieve a higher risk to reward ratio? To take profit further, we need to look at the higher time frame. Look at the higher time frame. We see that taking profit to this point is also a key level. On the higher time frame, the higher time frame is still bullish. Taking profit to the key level of the higher time frame, which is bullish, is very good, very safe. So, can we take profit further out, like this, for example? Let's analyze it. Although the higher time frame is still bullish, it has returned to the key level of the higher time frame here. It rose, but it hasn't broken through the previous high. It reversed downward like this. It reversed downward like this. Is it possible that it returns to this key level again, a second retest, and then continues to rise? The answer is yes, anything can happen. But for me, that probability is low. Usually, the price retests the key level only once, and then it should break through the previous high, moving straight up. But in the case where it retests once and still doesn't break the previous high and returns again for a second time, the probability of it continuing upward is low. It's more likely to go down. This indicates that the uptrend is weakening. So, we have a basis to take profit here. Predicting that this uptrend is weak. Taking profit here gives a risk to reward ratio above 112. But of course, taking profit this far out is just our prediction. It hasn't become reality. It's just a prediction for entering early. We can't take profit that far recklessly. It's very dangerous. So, when the price reaches the key level here, manage the trade, take partial profits, take half the profits, and if your psychology for holding profits isn't good, take even more. Take 70% or 80% out, leaving only 20% or 30% to hold. Remember, take profits in parts. Here, I take half the profits from my trade. The rest, I continue to hold. And the price hits the take profit. That's the main content of this video. Although entering trades this way is safe with a high win rate, the market doesn't always wait or retrace for us to enter. There have been many times I predicted the price would reverse where I expected, but I still didn't enter immediately. I stayed disciplined, waiting for confirmation for safety. But after getting confirmation, sometimes the price just moves straight ahead, leaving me feeling regretful. And that feeling of regret makes me constantly try to improve my perspective, improve my analysis skills, and improve my trade management skills. To take on more risk, accept riskier trades, to avoid that feeling of regret. But when I keep entering early trades, to avoid that regretful feeling, eventually, I fall into a trap. Regret is bad, but falling into a trap is even worse. So, later on, I balanced between entering safe trades and entering risky trades. It's not about 100% safe trades or 100% risky trades. So, advising others to only enter safe trades, I think that's not the best approach either. Find a balance that suits you, like 70% safe trades and 30% risky trades, for example. Find a ratio that works for you based on your trading results and your risk appetite. And that's everything I wanted to say in this video. Now, I'll wrap up this video. Goodbye, see you all in the next video.